Hi everyone. Okay, as more people are coming in, um, we'll just wait, I think, 2 to 3 more minutes to let more people join the session. So in the meantime, let me know in the chat if there are if you guys can see me clearly and can hear me as well. Basically, just let me know if there are any issues before we get started. Okay, seems like everything is okay. Okay, we'll just wait maybe 1 to 2 more minutes to let more people join. So in the meantime, you can grab yourselves a drink, make yourselves comfortable, and we will start in a little bit. Let me know in the chat as well, since today's webinar is on scalping. Let me know if any of you guys are scalpers or you've tried it before. Just curious to know how many of you guys enjoy using this method. Yeah, you see some of you guys are scalpers yourselves. Okay, some of you guys aren't. That's fine. We'll just briefly go through an introduction. Yeah, and then we'll go into some trading strategies that you can implement. Okay, I think we can go ahead and get started. Okay, so hi everyone, welcome to our Trade Management Series webinar. So this is brought to you by Everest Fortune Group in collaboration with IronFX. So today's first part of our series will be on scalping. And okay, before we get started, just a risk warning. Okay, Michael is a scalper most of the time. That's cool. I do like scalping as well. If I don't have that much time to sit in front of the computer, I think it's a good strategy as well. So we'll go through 3 powerful scalping strategies at the end of the webinar. So you guys can keep a lookout for that. Okay, so a risk warning, our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so here's our agenda. We'll just do a brief intro to scalping for those of you guys who aren't familiar with it. And then we'll take a look at Fibonacci confluence and where you should place your stop loss and take profit. And then stay tuned to the end to where we'll go through 3 powerful scalping strategies. So I'm your host for today. I'm Melanie. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay. And if you guys were curious, you can feel free to connect with me on LinkedIn as well. It's just my name. Okay, so what is scalping? So it's a fast-paced, exciting, and mind-rattling all at once So basically, it's where you take trades for short time periods. So you grab very small amount of pips and you risk very small amount of pips as well. So you're basically taking advantage of market volatility in this case. And the time frame, if you guys were wondering, for scalping is normally on the shorter side, just so that you can catch all of the market volatility, the market movements. So it's briefly, we think that 1 minute to 5 minutes is a little bit too short. So because the time frame is so small, it can get really your charts can get really noisy and it might be a little bit difficult to catch all of the movements and conduct your analysis because of the constant movements. So we like to stick with 15 minutes to about 1 hour for scalping. Okay, so why scalp? Um, there are known unknowns. Okay, so what we mean by this is a good example would be if the NFP is coming out tomorrow, for example. You know that the event is coming, but the outcome is unknown. So these events can really mess up a trade. So in this case, you would use scalping so that you can avoid any um, any known unknowns, basically. Okay, and locus of control. So let's use weather forecast, for example. So if there's a 1 hour forecast versus a 1 week forecast, you are likely to have more control over what's happening in the next 1 hour versus over the next 1 week. And new opportunities every time you open the chart. So market moves really fast on the M30 and H1. So there are new patterns every couple of hours. Okay, so how much time do you need to scalp? Time commitment wise, you basically have to find the trade and set the trade management. We'll talk a little bit about stop loss techniques and stuff like that later on. But that's basically all you need to do. Set the trade, make sure that your risk management strategies are intact, and that's it, you're done. And then you just have to review it every few hours. So the holding time is typically from a few seconds to a few hours, depending on your own strategy. So our recommended time to trade, or rather the different amounts of time that you have to put in, will be 1 hour in the morning, an hour in the afternoon, and an hour in the evening. So it's not too time consuming. And it's important to have proper risk management so that you don't need to monitor the trades all the way. Okay, so this talks about your trading stop loss, the different stop loss techniques, which we will briefly talk about later on in our slides. How much leverage do you need to scalp? So this is typically quite a high leverage strategy. So it's about 1 to 100 onwards. And you normally would use low spread pairs. How much capital do you need to scalp? So a good amount to start with is 250. That's just our recommended amount. Of course, it's completely up to you. Decent leverage of at least 1 to 100 is preferred, but not necessary. Um, so if we're talking about what exactly is leverage, so if we take, for example, a trader who deposits $1,000, so they can use $100,000 with a 100 to 1 leverage in the market. So this can greatly magnify your returns, but also your losses. And this is considered acceptable as long as only 1% or less of the trader's capital is risked on each trade. So what this means is that with an account size of maybe $1,000, right? Only $10, or which is 1% of 1,000, should be risked on each trade. So while this is difficult in practice, traders should avoid the temptation of trying to turn their 1,000 into 2,000 quickly. Okay, so yeah, so if you can do it with $250, then you can do it with 2,500 and 25,000. But definitely don't rush into scaling up. Okay, now let's get into the three powerful scalping strategies first. Okay, so firstly, we have the horizontal pullback strategy. So if you guys were here for our recent support and resistance series on our webinars, yeah, this would be familiar with you. Next would be our Fibonacci retracement strategy. So it's pretty straightforward. You're basically using Fibonacci retracement to see where prices will retrace towards. And lastly, we have the 90 tick strategy, or what we call Fibonacci extensions. So let's get into these now. Okay, we're going to start with horizontal pullback strategy. So a horizontal pullback basically means that we are expecting price to pull back or retrace back to that level. So in this example, we see that we have a multiple swing high resistance, this red area. Okay, we have three swing highs that all line up along the same area. And then price surpasses this resistance. So it breaks out of it. And since it's breaking out of it, we are expecting price to return back to that level. If you're wondering why we can expect price to return to this level, it's because of this multiple swing high resistance. So basically, the more number of swing highs or swing lows, if we're talking about support, if we have more swings that line up in the same area, price is likely to return and respect that area again. Okay? So in this case, since it's a resistance at first, we are now expecting it to become a support. So from a resistance, once price surpasses it, now we call this a pullback support level. Okay? If we are looking at a multiple swing low support, same thing when price breaks past the support level, we're expecting price to retrace back to that same level. Okay, in this case, we are calling it a resistance. Okay, let me know in the chat if it's a little bit confusing. Okay, but here's a couple more examples. So the key basically to scalping is making sure that you have a bunch of indicators and a bunch of graphical analysis that all supports your analysis. So if in this case we have price moving below the Ichimoku cloud, so that's a bearish signal. Okay, and price has also broken out of this swing low support. Okay, so we're expecting it to return back to that level. And you can see that's exactly what it did here. Okay. Next, let's talk about the Fibonacci retracement strategy. So firstly, this is an example of an insignificant swing. So just a reminder that these swings should not be used as Fibonacci points. Okay, because the swing highs and the swing lows are too insignificant. Instead, this is what you should be looking for. Really clear troughs and peaks and very clear market movement. So this forms the basis of all starting, middle, and ending points when we're using Fibonacci levels. Okay, so you shouldn't pick swing highs and those that are not significant. meaning that they need to have a relatively big move before or after it. So as a rule of thumb, you can use at least 15 bars before or after to see if they are really significant swings or not. Okay, another reminder. Okay, when you're drawing Fibonacci retracements, projections, extensions, or expansions, whichever you are doing, there's one important rule that you have to follow, and it's that your Fibonacci line must follow price structure. So your trend line can deviate from structure, but not by too much. So if you look at this example here, you can see that price doesn't really follow price structure over here. Okay, so this is what we've drawn is the shape of the price, and our Fibonacci just cuts through the shape entirely. So the trend line deviates from price structure by too much in this case. Okay. Next is our strategy. So the tool we're using here is Fibonacci retracement, which you can get from, it's the same tool that's on TradingView as well as MT4. So Fibonacci retracement percentage, excuse me. So for the percentages that we use for retracement, we use mainly the 5. So it's 23.6, 38.2, 50%, 61.8, as well as 78.6. So those are the levels that we use for Fibonacci retracement. Okay, so let's do a bit of a recap first. When you're picking the starting point, so basically your entry or your support or resistance levels, there are some rules that you have to follow. Firstly, we want to check if there's a swing high or low, pullback, or overlap level. So we talked about pullback already. Overlap, if you weren't here for our support and resistance, overlap basically means that there is a swing low as well as a swing high that are at the same level. Okay, that's what we call an overlap. So secondly, we want to make sure that our starting point goes back as far as possible. And you want to make sure that it doesn't intersect too many bodies of candlesticks, but the wicks are fine. So you see in this case, it's just the wicks, so it's an okay thumb. But we are preferably looking for really significant swings like over here. Okay. Another example here, we're cutting too many bodies of candlesticks over here, which is why it's not um it's not preferred. If you look at the green thumbs, we have really nice multiple swing highs that line up nicely, as well as overlap levels once the swing low touches that same level. Okay, and we see here as well another swing high here. Okay, once again, cutting too many bodies of candlesticks over here, which is what we want to avoid. So in this case, in order to rectify the situation, you can actually just stop your support level over here. So it's a support level because price has already surpassed this resistance, thus making it a pullback support because we're expecting price to pull back or retrace back to this level. Okay, so we talked about the pullback already, so I'm just gonna really quickly skim through this. I'm just gonna show you guys the GIFs. Yeah, and show you guys how we look for pullback support and resistance levels. Okay, so here we are making use of two levels, or rather two Fibonacci trend lines. Okay, we have this really long one here and one small one here. And then we highlighted the area where we are expecting price to retrace off of. Okay, so the 61.8 and the 38.2 that we see here lines up nicely with this swing low. Okay, so a pro tip is that when a pullback support level lines up with a Fibonacci level, in this case we have two Fibonacci levels, so it's a very powerful level. Um, okay, because for this webinar we are focusing more on scalping strategies, so the time frames that we're looking at are on the shorter side. So briefly from 15 is like the lowest that we go, 15 to about 1 hour, preferably 30 to 1 hour for scalping. But this strategy can be used for pretty much anything, even if you are a day trader as well. Okay, but yeah, for this webinar, mainly focusing on the shorter time frames. Okay, we looked at these examples earlier. No worries, friend. So we have another example here, the pullback resistance as well. So you can see that we have a significant swing low here, right? And price has surpassed this level. So once price has surpassed it, it then becomes a resistance because we're expecting price to pull back to this level. And you can see that's exactly what it did. If we move on to overlap, so I already briefly mentioned it earlier, but yeah, this GIF basically tells you what an overlap is. It's when there are bulls and bears that are respecting that area, which is why it's an important point to take note of. Similarly, if overlap areas line up with other elements like Fibonacci or graphical elements, then it'll make it even stronger. Okay. Um, Here's another example. I think you guys have kind of gotten it by now. But just another example in case you weren't clear. So this is a pullback resistance first, okay, because price has surpassed the swing low level. So it's surpassed it, we're expecting price to pull back to it. And once price pulls back to it, as we see in this GIF, and reverses off of it, it then becomes an overlap level instead. So the difference is that the difference between pullback and overlap is that once price reverses off of the level, then it becomes an overlap level. Whereas for pullback, we're just looking for price to surpass it. Okay, so now that we know what overlap and pullback levels are, we can combine them to find strong resistance and support levels. So sorry about the text, but here we have a big swing high resistance level. Okay, price surpasses this level and becomes a pullback support. So we expect price to pull back or retrace to this level, the same rate level here. Okay, and in the green arrows, we see price retrace this level and bounce off of it perfectly. Once price bounces off the pullback support, it then becomes an overlap support level. Okay. Combination of pullback and overlap, um, same concept over here. We have two swing high resistance and then a pullback support once price surpasses it. And then we can see price actually respected the area twice in this case. And then once price bounces off of it, it then becomes an overlap support. So actually, even after the first bounce off of this level, it's already an overlap support. Okay, but yeah, we normally when it happens once, you can expect it to happen again. Okay, another example here. In this case, we have many we have prices respecting this 33420 level many times. Okay, with swing low supports, then a pullback resistance, and then it pull back to our resistance 3 times, and then a pullback support, and then back to our support level. Okay. Here's another example. Okay, we have this double swing low support. Price breaks out of it. Okay, we're expecting price to retrace back, but we also have a Fibonacci retracement. You see here 61.8 that lines up with that same level. We also have this 100%, this bigger Fibonacci level here with a 50% Fibonacci level that lines up with the same area. Okay, so this makes it a confluence area, which basically means that you have multiple Fibonacci levels that line up with the same area. Okay, so the reason why that's important is because price is always more likely to be attracted to these areas of confluence. And you can see over here that price was attracted to this area, okay? And then we're expecting it to bounce off again. Okay, like we see over here. Okay, so like I mentioned earlier, we typically want to try and use graphical techniques, indicators, different kinds of um, indicators basically to support your analysis. Okay, here we see that we might have a descending trend line, but you guys know that a valid descending trend line, you need 3 significant touches because 2 is quite common, okay? But we have price moving below the Ichimoku cloud, okay, but it looks like it's breaking out. We also have this almost descending trend line here, okay? And we also have a Fibonacci retracement where 38.2 lines up with our trend line over here. Okay, and we're also making use of stochastic in this case, where we see that we have 3 swing highs that all line up together. So what this is called is a hidden resistance level. Okay, which basically tells us that price is likely to drop again, like we see over here. Okay, we see it happen twice. Price is making a lower high. Okay, but then over here on our stochastic, it's the same resistance level. So we can expect it to happen here as well. Okay, any questions about this? Okay, all good. Let's move on. So this is our third strategy, which is the Nike tick strategy. So it also makes use of the Fibonacci retracement tool. Okay, but instead we are using the levels that are more than 100%. So not included here is the 161.8 level as well. So we use 127.2, but we also use 161.8. And this is basically how you use it. Okay, so you have a starting point and an ending point, which is where you draw your Fibonacci trend line. Okay, and the shape that we're looking out for is basically like a Nike tick. So you have you want to make sure that the tail of your tick surpasses 100% of the starting point. Okay. Yeah, and then you see you're projecting where price will reverse off of. So in this case, price reverse off of the 161.8, and then we expected a reversal here. Maybe I'll just show you guys like where you guys can find this on our website. Okay, so you can find it over here. This is just the forexarmy.com. Maybe I'll just pop it into the chat. The Okay, so we have a bunch of trading guides and tools as well. So the tools are mainly for MT4. Just a bunch of indicators, free indicators for you guys to download. Okay. Yeah, support resistance guide and how to draw Fibonacci retracement correctly. So if after this you are still a little bit confused, you can go ahead and look at the extensions. So the extensions is basically what I'm referring to now, the Nike ticks. Okay. Retracements are really basic Fibonacci levels that are important as well to know how to use. Okay, so we have the clear market structures. You can see what to look out for. Yeah, you can go and explore this on your own along with the different confluence areas. Okay, and we'll talk a little bit about this towards the end of our webinar today as well. But yeah, if after this you're a little confused, you can go ahead and check the Forex Army out. Okay, so another example here of a Fibonacci extension. Here it's pretty small. Okay, we have a really small tick here. So you can see the hit um from the 100% to the 0%. That's where I've drawn the trend line. Okay, so I've drawn the trend line and then I'm projecting where it goes. So I see that firstly, I have a swing high resistance here. Okay, so this is my where I'm projecting price to go towards, but I see that it's also in line with a 127.2% Fibonacci extension. Okay, so it makes it a significant level that you can see over here. Hi Azif. Okay. Yeah, so this is the shape that you want to be looking for basically, with the hit of the tick like this. And you can only use this technique once price has surpassed more than 100%. Okay, but the shape is like a Nike tick. In this case, I'm showing you guys an example of an inverted Nike tick. So the shape that we're looking for, same thing, we're looking for the head to be shorter than the tail. So the tail has to surpass 100%. Same idea, completely the same. It's just that it's upside down. Okay. In this case, we see that price has surpassed the 127.2%. Okay, so we are expecting price, or rather we're projecting where price will go towards. And in this case, we have price, we have a swing low support that lines up with the 161.8% Fibonacci extension. And you can see that price is reversing off of this level. Okay, so here's how it works, or what we are looking out for when we are using this technique or this strategy. Okay, so we're watching for the reactions of the 127.2 and 161.8. We're expecting it to reverse off. That's basically what we are doing with this strategy. Okay. Notice how we only go in with the Fibonacci extension after price breaks out of the 100% level. Okay, let's move on. So here's another example of the Nike tick strategy. So the time frames that we recommend for this are 30 minutes, 1 hour, and 4 hours. the entry criteria is that once price breaks out of the 127.2%, stop loss level, okay, these are just recommended areas. So you don't have to follow these closely because charts are completely different. Okay, I don't think you guys can find a chart that looks exactly like this over here. So these are just our recommended areas for you to reference. Okay, so our idea invalidation level is the 138.2. Break even is 11% of the recent move. 50% take profit is also 11% of the recent move. Full take profit, 22% of the recent move. And then for bonus, we will go in with other Fibonacci techniques like retracement, expansion, projection, and also support and resistance, like we previously mentioned. You're going with your pullback as well as your overlap levels. Okay? So this really just for your reference, okay? It's not like you really have to stick to these levels. It's just if you're starting out and you don't know where to place your levels, you can just follow this guide. Okay, so here is the long example. Um, Here we have two Fibonacci techniques that we're using. Okay, firstly, it's a little bit hard to see, but we are firstly using a Nike tick. Okay, let me show you guys where the Nike tick is from here to here. Okay, and then we see price surpass the 100%. And then we see the 127.2%. Or it looks like price is approaching it here. Okay, and then we go in with our projection. So our projection is from here. Projection uses 3 points, okay? So the starting point here, middle point here, and ending point here. Okay, and for projections, we use 3 levels, 61.8, 78.6, and 100%. So we see here that the 61.8 lines up with the 127.2 at this level here. Okay, so we can see that price reacted off of it nicely and shot back up. Okay, maybe another technique that I just want to briefly mention is our Fibonacci expansion. So for expansions, let me try and find it. We use the negative levels. Okay, we use the negative levels, minus 27.2 and minus 61.8. So for this, we look for the flash kind of shape like you can see here. And we can often use this Fibonacci expansion with your projection levels. So like I mentioned, the 3 points. The 3 points is your projection, and we normally can use that with the negative levels. So you can see here the negative levels, we have minus 27.2 and minus 61.8. And you can see how price reacted off of the minus 61.8 really nicely. Okay, now we're going to talk a bit about trade management with confluence. Okay, so a good habit is to place your stop loss beyond a key Fibonacci confluence area. And the reason for this is because more often than not, price is attracted to areas of Fibonacci confluence, like we mentioned earlier. So if your stop loss is right before it instead of beyond it, you will likely get stopped out before the market reverses. Okay, so this is one of the reasons why people wonder why they get stopped right out before market starts to reverse, and then they start to complain about stop hunting. Take profit, on the other hand, you want to place it before a major confluence area. So when price reaches the Fibonacci confluence area, there's a high chance that it won't be able to go beyond it. because obviously we're expecting it to reverse. So instead of it reaching your profit target, it's likely to reverse back to your entry instead, or maybe even to your stop loss. Okay, so and then people will complain that the market is being manipulated because they missed their take profit by 1 pip. So here's an example of how you can place your stop loss and take profit, just to maximize your wins and minimize your losses. This is also on the forexarmy.com website, so you can go ahead and take a look after this webinar. Okay, Fibonacci confluence. So multiple Fibonacci retracement lines up together, so we know that this is what makes a proper Fibonacci confluence, and the example is over here. Okay, we have minus 27% Fibonacci expansion, as well as the 161.8 Fibonacci extension that all line up nicely here. Okay, so maybe just to break it down for you guys, the minus 27% Fibonacci expansion, we're looking for flash or lightning bolt kind of shape. So you can see that over here. Fibonacci projection, similarly, we are also looking for a flash shape. That's why I said these two can likely be used together normally. Okay, so you can also see it, see the lightning bolt shape. And then the 161.8 Fibonacci extension, this is our Nike tick strategy. You can see that the Nike tick is inverted in this case. Okay. Yeah, and you can see price bounced off of this level. Another example here, we have the 127.2% Fibonacci extension, right? So this is the extension, and it lines up with the 61.8% Fibonacci projection. So the 3 points over here. Another example, 100% Fibonacci projection. So you can see the 3 points once again is your projection. I think you guys can see the lightning bolt shape here. And then we use a 127.2% Fibonacci extension. So you can see the Nike tick shape. So what we are looking for is basically levels that kind of look like this. So as long as you have two levels that line up nicely. Okay, so we're combining Fibonacci methods again. In this example, Fibonacci expansion. So you can see the lightning bolt shape here. And we have a minus 61.8% and the 161.8% Nike tick. So you can see the tick here. Okay, and we are projecting it to reverse off of this confluence area here. Okay, so we would expect it, or rather we would project it to reverse off of the higher area, obviously only when price breaks out of this level here, which is why it's good for scalping, because then you can take these small movements pretty easily. Okay, another example here. Okay, the minus 27.2% Fibonacci expansion. This is once again the lightning bolt shape. You can see it really clearly here in this case. And then the 100% Fibonacci projection, also lightning bolt shape. And then the 127.2% is the Nike tick shape. So you can see it. It's inverted in this case, okay? And all of these three levels line up and we see price reverse off of this area. So it's attracted to these areas, but it's not likely to go beyond it. So it'll be attracted to it, it'll test this level, and then it'll reverse off. That's the kind of movement that we're looking for here. Okay, If we look at dynamic take profit and stop loss placement, okay, your swing high would be your stop loss in this case because we're expecting price to hit towards our take profit. So we're going in for a sell in this case. Okay, so take profit is your swing low resistance here. Entry is at this um swing low support that's turned into a pullback resistance level. Okay, and this level is also in line with the 78.6% Fibonacci retracement. So price hits our entry really nicely and reverses off of it and hits towards our take profit. Okay. Another example here. This is the same example, sorry. But in this case, I'm showing you guys that we have another Fibonacci retracement. No, this is a projection, sorry. So we have a projection here with a 78.6% that lines up nicely with our take profit. Okay. And then we see price just touched our take profit before reversing off of it. So this is why it's so important for you to know where to place your take profits and stop losses. Okay, because you can see here, um, it'll drop and then reverse off of it really quickly. So you have to be able to catch that touch before price reverses. And you can see it's really good that it touched nicely because it went straight to your stop loss after that. Another example here. Okay, we have price breaking out of the descending trend line. So since it's breaking out of it, it's giving us a bullish signal. And then we have this entry level. We have our entry level here, which is a significant level. You can see the number of times that price has tested it. And then you can see that we have a lot of Fibonacci levels that line out nicely. Okay, we have the minus 27.2 Fibonacci expansion, 127.2 Fibonacci extension as well. Okay, and these all line up with this level here, which we then make our take profit. So if I had placed my take profit above the confluence area, price actually reached it and reversed off of it. So it would have missed my take profit by a few pips. And it would have hit it straight to my stop loss. Okay, whereas if I had placed my take profit below the confluence area, price hits our take profit nicely before reversing back down. Okay, okay, that's it for my slides. Let me know if you guys have any questions. Maybe just to summarize, the three scalping strategies that we went through today, okay, were oh, were the Nike tick, which is the last one that we went through, and then the retracement as well as the pullback. So basically, you can use all three together, and that's the best strategy is to combine all and form a confluence area so that you know which areas to look out for, and of course, know where to place your take profit and stop loss levels as well. Okay? Once again, if you have any questions after this webinar, feel free to check out forexarmy.com. Most of the information is there. How do we access previous sessions? I'm not sure if it's on YouTube. I think you can check YouTube first, the IronFX YouTube. But if it's not there, you can email IronFX. Okay, thanks so much, Wayne. Hope you learned something from this. Yeah, if you guys don't have questions, feel free to leave the session. Have a great rest of your week, and I will see you guys next week for our um, our second part of this trade management series. And you can find me on LinkedIn if you want. Thanks, friend. See you guys next week. Bye, everyone. Thank you. Thanks, Riaz.